Hi guys, today I want to cover some of the reasons why Chinese stocks have once again dropped so drastically. Before we start, I have long position in Alibaba's Hong Kong ticker 9988 as well as JD.com and Yum China. However, I'm not looking to sell these shares anytime soon. Please keep in mind the financial disclosure that I am not a financial advisor and please do your own research. Chinese stocks took a hard fall yesterday as the surge of coronavirus cases in China have raised worries about an economic downturn. And reports that Russia has asked China for military assistance have spooked investors, who fear a global backlash against Beijing. The Hang Seng Index closed below the 20,000 mark, a 5% drop from the previous session and the lowest since March 2016. Alibaba Group was down 11%, hitting its lowest point since listing in November 2019 for the second day in a row. Tencent Holdings also dropped 10% to its lowest level since March 2020. In addition, JP Morgan double downgraded the stock from overweight to underweight, drastically changing his target price on Alibaba to $65, down from the previous $180. He believes that more global investors will flee Chinese internet sector owing to weakening consumption confidence and geopolitical risks. Analysts also see China internet names as uninvestable on a 6 to 12 month view. And yet, amidst all of that, Kevin O'Leary, a prominent American investor, has bought shares of beaten down internet companies. He noted that he isn't sure he is buying the bottom, but he's making a fundamental decision about the headwinds China is up against. He believes that the main headwinds are the ADR structures, but he believes that these are overblown concerns. According to a report published by Deutsche Bank, stocks have sold off because of delisting risks of Chinese ADRs, as according to HFCAA, foreign issuers which fail to meet audit requirements for 3 consecutive years will be banned from trading and delisted from exchanges. If delisting were to occur, there could be 3 possible outcomes. Firstly, share buyback or privatization. Secondly, ADRs converted to Hong Kong shares. And thirdly, investors would have to hold the equities and trade in over-the-counter markets. Among these 3 options, the swap of ADRs to Hong Kong shares should have the least negative impact, and thus shares which are dual listed in Hong Kong should be preferred. Most of the larger Chinese internet names are already dual listed, with the exception of Pinduoduo. According to news last year, Weibo is already in talks to potentially take the company private. I think that while this will take out some of the interest from US-based investors, these are more sentiment and technical negative than fundamentally negative. I think that while most BABA back holders are likely in pain, it definitely does not make sense to be selling out at this point, and it will be something that I will not do. Firstly, with regards to the outbreak in COVID, while serious, I believe that it can be contained quickly with the efficiency of the Chinese government. The issue I'll be more concerned with would be any retaliation against the Chinese government over its ties with Russia. It is currently not clear if China intends to provide Russia with any assistance. One of the sources suggested that food might be a request that China would be willing to meet, because it stops short of lethal assistance that would be seen as deeply provocative by the West. The Chinese Communist Party leadership is also not all in agreement regarding how to respond to Russia's request for assistance. 2 officials said that China's desire to avoid economic consequences may limit its appetite to help Russia. Officials also told CNN that Chinese President Xi Jinping has been unnerved by how the war in Ukraine has reinvigorated the NATO alliance. Therefore, I think that China will ultimately not want to provoke NATO, especially at a time where its economy is showing serious signs of faltering. In addition, even though China's central bank has kept its policy rates unchanged, it is likely that it will ease monetary policy going forward in order to reach the government's annual growth target of around 5.5% this year. So to conclude off this video, I will not be selling any of my China internet names, and I'll probably encourage anyone who doesn't have these names to start dollar cost averaging down. I believe that these stocks will still grow in the future and will make good returns if you hold it for the next 3 to 5 years. I'll make another video covering BABA's 4Q21 results and valuation. See you next time.